Hey, it's Mike for another episode of my vlog. We're here once again at the world headquarters of Newmark Knight Frank. Thank you for hosting us and thank you for all that you do for the commercial real estate tech sector. So in today's episode of the vlog, I wanted to focus on some of the VCs that are the most active in our particular space, and the ones that I also look to for sort of real thought leadership is where things are going, what the future looks like, and they give me great ideas for my content at my events. And with all due respect to my friends in the venture community in Los Angeles and in San Francisco, Chicago, Boston, Miami, throughout the world, my opinion, the center of CRE tech investing is really here in New York. It's where I think we have the most prolific funds and the most activity. So I've asked four of my great friends who are all based here in New York on the venture side of CRE tech to join me in a discussion about where we are with VC funding, accelerator, early stage investing in the world of CRE tech. So it's my pleasure to welcome my good friend Jeff Berman of Camber Creek, David Goldberg of Corrigan Ventures, Ed Walters of Tamarisk, Andrew Ackerman of Dreamit. So I wanted to start the conversation with a little bit of a different sort of line of questioning and discussion. We always talk about when we get together, and we do this so often, like, what do you like? What are you investing in? What are some of the hot startups? And so I wanted just to sort of get to the next level in terms of conversation. So one of the things that, since you've all been doing this for a while, that I thought would be interesting to start would be, since you've been doing this, Jeff, right, from the beginning to where you are today, what's changed? What's new? What's different as opposed to when you first entered the sector?
I think the most obvious change has been the amount of attention being paid to it, right? I mean, specifically, even over the last, we've been doing this for 10 years, and over the last 18 months, I don't know about you guys, but I've seen a marked step change in the amount of attention that the big real estate corporates are paying to the sector, and you know that owes in large measure to the efforts of you and the wider media that are starting to look at this. You've been in it from the beginning, but people are really saying, oh, real estate, largest asset class on the planet, massive white space, big opportunity. Right. So that's really the biggest change I've seen.
David, what about you?
Yeah, I'm actually going to piggyback on what Jeff said about the attention given to the space, but focused on the actual entrepreneurs and founders who are tackling it. I think, so our first investment in prop tech was late 2012, but we weren't as active back then because just the quality of founding teams that we saw just wasn't up to par. It was a lot of brokers who maybe had the entrepreneurial spirit but didn't really understand technology or the nuances of the industry, or you had some tech folks who knew there was a big opportunity but didn't have the domain expertise or the relationships to attack it. Fast forward now 5 or 6 years later, and you're starting to see these super teams of repeat entrepreneurs who really know how to execute just at a different level. Right, great.
Ed, what about you?
Yeah, I mean, I couldn't agree more. I mean, from capital to teams, on the capital side, I think in 2011, there was recently some statistic that $120 million went into prop tech. Now it's 12 billion, I think, globally, right, which is like a profound, it's more than a step change, it's exponential. I think the interest from large real estate groups as customers has also really changed. It seems like every day now at the kind of corporate board strategic level, there's this question of how do we either mitigate some kind of existential disruption, or how do we create some sort of kind of competitive advantage? And that conversation wasn't happening so frequently, I think, even 2 or 3 years ago when we were first making investments. And for us, it's a good thing because it means that customers are actually willing and ready to pay a lot of money to scale these things.
Yeah. Andrew, you guys are...
So I came at it from a slightly different perspective. Right? These guys have real estate in their bloods. They've been doing it for like decades and generations. We came to it from a little bit more of a cold-blooded, quantitative perspective. So as you guys know, we also are operating health tech. We've been doing health tech for a bunch of years. So when we started looking at real estate and construction tech, we wanted to make sure we were in that Goldilocks zone, not too soon, not too late. So we started looking at, this is going back to 2016, 2017, the amount of activity there was in seed and A round investments. And what we found when we crunched the numbers, including what we wanted and the stuff that we didn't want taken out, the amount of activity in that space was within 1 percentage point of where health was when we got in 2012. So we're looking at it like, wow, this is exactly where we want to be. Right. So the next question began, is the slope of the line up, right? Or is it going to be flat? So our thesis from talking to a lot of people in real estate and construction, we play in both of them, was they are ready to pilot, right? After many, many years of saying like, there's no data, it's not good enough, I don't need to change. Suddenly there was that kind of fear in the back of their eyes that if they didn't start innovating, like they were going to get left behind. Right. And that was our thesis, and we jumped in, and absolutely over the past 2 years, we've seen that. Corporate after corporate are setting up funds, they're hiring chief innovation officers, and they're actually paying for pilots. Right. So it's absolutely been like the ice is coming off of the iceberg, and big chunk by chunk. Yeah. In real estate, finally.
What surprised you, though? I mean, that's, you know, what you talked about, Jeff, like we're getting all this attention now, which is great, but what still surprises you?
Well, I don't think much surprises me about it. I think the general environment is very ripe. And so if you want to use the word surprise, I would say, I can answer that. I would say that Andrew was saying, well, there's a willingness to pilot now, but we're still seeing a lot of reticence, even though there's a lot of attention being paid to the space, and 12 billion went into it globally last year. That's a drop in the bucket in the venture hat. Right. So there is still a big resistance to change and change agents within the business. So I think what's surprised me is, despite I would say the exponential growth in the space and the amount of investment in the space, the reticence to try new things among industry stakeholders, even though they've woken up, is still like, well, slow down.
Right, and that's a great answer. That's what I was alluding to, is like, what are the challenges that you still see, given the fact that the amount of money that's coming in, as Andrew said, the amount of press and attention that we're getting. But
you also have to qualify
what's the challenge?
A bulk of that money that came in last year went to 2 companies. So
exactly. For us, we're early stage guys, so if you get 1 or 2 D round financings, it skews all those numbers. We really look at the early stage. I'm actually going to flip what Jeff said, right? The real question that like I tried to answer is, why didn't this happen 5 years ago, right? We asked that of all our startups, like why is what you're doing something that couldn't have been done 5 years ago? So odds are, if it could have, someone has tried it and failed, and you got to understand why. I think there's 2 factors here, maybe 3. Number 1, it's not easy. Real estate's a lot harder than a lot of other industries. So they went after the low-hanging fruit first, so that may be part of it. Number 2, data just weren't there. Right? The data in real estate is messy, it's conflicting, it's hard to get. Still, better than it was 5 years ago. Right? And data becomes addicting. So once you start getting data, a lot of things start opening up. So that's number 2. And number 3, perhaps, is the dramatically falling cost of sensors and other items like that. And it ties to data, right? Until you have those, you can't get the data. Now that these things are so cheap, almost like throwaway cheap, a whole lot of other opportunities open up. So if I had to point to like the things that, why now? That's why I think it's now. And as to your point, there's always going to be stragglers. There are the guys that are ahead, they're doing it. Sure. There are the guys that know they need to do it but don't know how to do it. And then there's always going to be the diehards that are like, I don't really need to do this.
David, from your perspective, you guys are doing a lot on the residential side, right? So what any parallels between what you've seen on residential versus sort of what's going on in CRE side?
So our physical portfolio is all mostly on the residential side, so we obviously have a preference there, but we've made investments and think there's opportunities really across the stack. One of the interesting things is, right, so a lot of people talk about the hesitancy or the willingness of real estate owners to really get involved here. If you look at some of the biggest companies that have come out of PropTech in the past, 5-6 years, Airbnb, WeWork, Compass, Open Door, I'm sure there's a few others, none of them are actually selling to owners, right? They're all kind of circumventing them and creating their own solutions.
To consumers.
Exactly.
Yeah, that's interesting. And what about your perspective?
For me, quite honestly, the most surprising piece has been the lack of financial innovation on how to actually finance innovation in real estate. We're all doing accelerators, incubators, venture capital, fund structures, and I think real estate's a tough model for that to make sense around. So when you think about tenant improvements, when you think about leases, when you think about large capex on physical assets, venture dollars are not good for that. And I'm surprised that given the amount of money that has gone into companies like WeWork over the years, that there hasn't been more innovation around how to actually build up large real estate portfolios in parallel.
Right. So you're talking about the actual real estate, not the real estate tech.
I am, and
They're connected.
they're connected. Yeah, I mean, one's improving the other, and when we answer to our LPs, we're thinking about financial returns, and when you think about the ability to allocate large amounts of capital, that for the, I think, foreseeable future in real estate tech is going to be actually more on the real estate side than on the tech side.
Yeah, I think the only thing we really see there that's not super innovative is sidecar vehicles, right? Propco, opco. Right. You're starting to see, right, if you talk to the SVBs of the world and some of the lenders, finding unique ways to finance some of the stuff, right? Whether it's finding lease costs, build outs, even customer acquisition type stuff. As more data rolls in and they get a little bit more comfortable there.
So that's interesting. I don't usually think about it in that part of the world. Like, I actually struggle with startups like WeWork or WeLive and all. It's an Airbnb style hotel. Like, I struggle about whether or not that's real estate tech at all, or is that a real estate play? Like, it doesn't scale like a tech company to me. So I struggle with whether or not I want to play in that field. Like, would I invest in a Compass, or is it really a brokerage with like a tech overlay?
What does it matter?
Well, it depends, right? So if I'm getting in at the A round and then like SoftBank buys me out at the D round, it doesn't matter at all. But I don't usually go into a deal hoping that somebody will buy me out later that doesn't see that nuance. I don't have an answer for it yet. Like, we're still thinking that through. But I'm definitely a lot more comfortable when it's a SaaS service that sells to a
middle ground. And David and I share this portfolio company, are the tech-enabled services, like Bowery, right? So Bowery has a platform that allows appraisals to be done 75% faster, but it is still a service, and it is a tech-enabled service. So I think there is that middle ground between the whole SaaS stack versus the whole real estate stack and somewhere in between. And I like to right. Yeah. And we like to play in that space because there's a lot of opportunity. I mean, it underscores our mission of creating more efficiencies in the real estate that we and our LPs own.
Yeah, and as an example, you look at Airbnb, right? And there, a lot of people and companies are now mining data from Airbnb to actually purchase real estate and operate it for a higher and better use as a hotel or vacation rental asset. I view that fundamentally as actually a data infrastructure layer that supports any kind of investment. Yeah. And so I think as we get more and more data, you can do more and more things like that on the real estate side. But it blends. I think it's part of the challenge for me.
That's a good example, right? So Airbnb, in my view of the world, it's a marketplace, right? They're not operating real estate. That is a pure tech company in a lot of respects. Yeah, okay, we'll see. Everything gets gray over time. Like, WeWork starts buying their own buildings. Right. That's pure tech. But then we get pitched by a guy who's got a concept. He has a bunch of places. He'll take like a long-term lease in a residential building for a floor, and he'll set them up the same way. It's got a consistent branding, consistent look and feel. And now he's a hotel. It's an Airbnb style experience. He's even renting them on Airbnb. But it's not a hotel with a front desk or a concierge or a kitchen or any of the back ends. Is that tech, or is that a hotel startup? Right. For me, that's kind of more on the hotel side than the tech startup.
So I'm curious what you guys think about, like, when you see some of these valuations, whether Open Door or WeWork or Compass and what have you. Is it a good thing for the industry? Irrelevant? I mean, you talked about most of the funding, I think, coming from a few getting these massive rounds.
SoftBank. I mean, it's
just a good development for the sort of the venture world and the CRE tech as a whole.
I think there's a nuanced answer to that. On the one hand, anything that helps evangelize the real estate tech space is a good thing. On the other hand, does this foreshadow a bubble in the space? Could be. So, you know, I'd be curious to see what the revenues look like for both of those companies. We're not in either one. To see, you know, how are those valuations justified? And then where's the capital coming from? And what does their cost of capital look like? Why are they deploying this much money?
But can I ask you like a naive question in that regard? Most of my questions are naive. Does it matter what their revenues are? If they're able to achieve round after round at that level.
Well, to us as investors,
I mean, does it matter?
Yeah, of course it matters.
Of course.
At some point, the buck stops.
Right.
Right? And everyone's got to make money.
Whose buck is it at that point?
Well, but you've seen, and there are countless examples, you go out to Silicon Valley of a company that has raised hundreds of millions, if not billions, at a multi-billion-dollar valuation. If they can't exit for that multiple and everyone winds up losing their money, the fact that at some point a news article printed the headline of their valuation, that's somewhat meaningless.
Let me build on that. It's actually worse for us, right? So the guys that get in later, what you don't write about, they got liquidity preference, right? So they can give an absurd valuation and their downside is usually capped. They'll get 1, 1.5, 2x back regardless. So that company really has to deflate like a souffle all the way down to like 20% of that valuation before the last guy in gets hurt. Right. The people that get hurt the most are people earlier on the waterfall, right, like the early stage investors, the entrepreneur themselves.
It's the founders and the employees.
So from a very dollar and cents perspective for us, it could hurt us. On the flip side is if they take me out in the D round or the E round, or taking me half my money off the table.
I think I agree it's nuanced. I mean, I think angels and employees are going to get hurt by these huge rounds. There's just no way to not get, I think, compressed. I think the first institutional money in often has more protection around it. So seed investors often can actually get out and sell their shares in a secondary and actually make great money. Right. I think it's actually often here the growth investors and corporate venture groups that get really hurt. The open question for me around everything from Compass to WeWork is, you know, who is going to buy these companies at these prices? I mean, the public market, there's a level of scrutiny that I think just compresses pricing. Who are the other acquirers? You know, who are the strategics that would pay $40 billion for one of these companies? I think it's a huge open question, and that's why I think this is a more interesting game right now as we ask the question for smaller funds to play.
Right, got it.